How many tax credits did your business miss last year, and how would you even know, right? If you're a US business owner paying serious money to the IRS every year and nobody is proactively reviewing tax credits with you before year end, it's a good chance you're leaving lots of money on the table. This show is where we legally shrink that bill and keep more cash in your business. I'm Chris Middleton from MakeTaxesFair.com, and today we're breaking down tax credits, why they're one of the most overlooked areas in tax planning, and how the credit optimization pillar of our Clear Edge framework helps business owners to stop missing them. Stick with me to the end and you'll know why credits matter, how they differ from deductions, and what to start looking for right now so next April isn't another unnecessary tax bill. Most business owners have heard of deductions, travel, meals, payroll, marketing expenses, the usual write-offs. Far fewer really understand tax credits, and that matters because credits can be one of the most powerful levers to pull in tax planning. Here's a simple version, right? A deduction lowers income that gets taxed, so a credit lowers the actual tax that you owe. Deductions save you a percentage. Credits can reduce your bill for dollar. It's a massive difference, and yet business owners are not proactively looking for credits. Why? Because credits aren't usually something you stumble into at tax time. They have rules, often require decisions and documentation before the return is filed. And some even require separate filings with state or federal agencies. That's why credits belong in tax planning, not in reactive tax preparation. Why credits get missed is usually here's how that goes. You get to tax season, hand everything over, and hope your CPA catches whatever they can, right? Again, tax credits are not always obvious from a profit and loss statement or a P&L. They're often tied to how and who you hired in your business, what improvements you made, what activities you engaged in, what industry and state you operate in. And if nobody's asking questions like this during the year, you won't even know a credit was on the table. If there's no process to pre-screen, apply for, and fill out the right paperwork, you could qualify on paper and still get nothing. So in the Clear Edge framework, we start with credit optimization. Not because it sounds cool in the acronym, although it did fit nicely into the Clear Edge, but because it's about proactively identifying, evaluating, and capturing those credits before they disappear or get ignored. What credit optimization really means is that we're optimizing and not just hoping that the credit is showing up. It's building in a process to identify, review, and make sure that you qualify for those things. Gathering the right support and documentation, making sure that the credit is actually captured as part of your overall strategy. It's very different than let's just file the return and see what happens. We stop hoping, we start planning. Common areas where credits live? Well, this episode isn't about listing every credit in the code. The point is to change how you think. Credits can be tied to things like, again, hiring certain categories of employees, accessibility improvements, research and development activities, energy-related investments, state-level incentive programs. It's one of the biggest traps of tax planning is ignoring the state level because you assume that something's only available at the federal. There's a lot of amazing opportunities at the state level and they're simply missed because nobody's reviewing. So credit optimization isn't a one-time thing. It's a build awareness and a process around proactively identifying. The costs of not looking for tax credits, I can show you in a real client scenario. There's a client of ours, their home services company, growing their business and their team. And over the last couple of years, they had expanded into 2 neighboring states and added more than 100 team members. When they onboarded with the Make Taxes Fair team for tax planning and implementation, we didn't just look at their past returns. We said, well, what are your growth plans now and hiring patterns now? And we quickly realized that they would be a perfect candidate for what was called the Workers' Opportunity Tax Credit, or WOTC. Because of their hiring volume, several of their new team members met the criteria for this credit. But because they had no process in place to pre-screen applicants or complete the required paperwork, the result was they missed over $50,000 of tax credits from the prior year alone. With the proper process in place, we helped them capture and claim almost $35,000 of credits for that year. And more importantly, they now have an ongoing system so that this credit doesn't get missed moving forward. The lesson is they weren't doing anything wrong. They just didn't have a framework. They didn't have a viewpoint on how to properly view credits. So why the credits comes first in the Clear Edge framework is because it reveals to business owners how the tax code actually works. The tax code is not a punishment system, it's a behavior incentive system. And the government uses tax credits to, again, encourage things like hiring in certain categories, improving accessibility, investing in certain activities and upgrades. So if you don't know what's being incentivized and what's on Congress's hit list, you don't know what you're missing. This pillar shifts your thinking from how do I survive tax season and get my taxes filed to what incentives should I be taking advantage of as I run this business. That's a far better question. So what should you start doing right now? Here's a practical takeaway. Stop asking, did we qualify for any credits, and start asking, what processes do we have in place to identify credits before they're missed? Look at your business and say, who did we hire? What did we improve? What are we investing in? Are there industry specific or state level incentives that we've never reviewed? If nobody's talking to us about this, we should be talking about it now. If the answer is we don't have a process in place, then chances are you're missing out on money. And friends don't let friends overpay the government. So why this framework beats random tips is credit optimization connects your legal structure, your employees, your documentation, your overall efficiency. And once you've identified credits, you have to implement it properly, document it, and then integrate it into a larger plan. Credits don't happen by accident. They qualify and you capture them by being intentional. And that's what the credit optimization pillar of the Clear Edge is all about. In upcoming episodes, we'll start to break down specific credits so you can see how they actually work in the real world and how they might apply to you and your business. The goal isn't to just file taxes, the goal is to make moves. So if this episode helped you even see one way that you might be missing tax credits by not viewing it correctly, don't just nod and move on. That's how the IRS keeps winning. This episode was a high-level overview of what credits are, how they fit into the Clear Edge framework, and we've created a resource that walks you through some of the more common credits currently available to business owners. So go to maketaxesfair.com/podcast for this show notes and the free guide that goes along with this episode. Again, that's maketaxesfair.com/podcast. Friends don't let friends overpay the government. If you have found that today's episode is helpful, please share it with a friend. I am Chris Middleton with maketaxesfair.com. See you in the next episode.